In the 2010s, Boohoo was unstoppable. It did not own high street stores, it did not depend on footfall, it did not move slowly. Boohoo moved at internet speed. New collections dropped weekly. Influencers promoted relentlessly. Prices were so low they felt unreal. Dresses for £5, tops cheaper than lunch, delivery in days. Investors loved it. At its peak in 2020, Boohoo's market value soared past £5 billion. The company was hailed as the future of British retail, proof that online fashion could outpace legacy giants like Debenhams and Topshop. And then, almost overnight, everything changed. A single investigative report exposed alleged labor abuses in Leicester supply factories, claims of workers being paid far below minimum wage, unsafe conditions, modern slavery warnings. Within days, billions were wiped off the company's valuation. Retail partners cut ties. Investors panicked. Regulators began circling. The same speed that made Boohoo powerful now made it fragile. This was not just a scandal, it was a structural exposure. Because what the public saw as an ethical crisis, investors saw as a business model problem. And when the dust settled, Boohoo was no longer a £5 billion growth machine. It was a cautionary tale. To understand how Boohoo's scandal wiped out billions, we need to break the story into 5 chapters: the rise, the model, the exposure, the collapse in confidence, and the reckoning. Founded in Manchester in 2006 by Mahmoud Kamani and Carol Kane, Boohoo positioned itself as a pure-play online fashion disruptor. Unlike traditional retailers, Boohoo didn't need expensive stores, long seasonal planning cycles, massive upfront inventory bets. Instead, it built a data-driven supply chain designed for speed. If a dress trended on Instagram, Boohoo could design it, produce it, ship it in weeks. That agility drove extraordinary growth. By the late 2010s, revenues were rising rapidly, year after year. The company acquired brands like Pretty Little Thing and Nasty Gal. Profit margins outperformed many traditional retailers. Boohoo became the symbol of Britain's online retail success. But here's where it gets interesting. Fast fashion at ultra-low prices depends on one thing: cost control. And that's where the cracks began forming. Boohoo's competitive advantage was speed. It relied heavily on a network of suppliers, many based in Leicester, to produce small batches quickly. This allowed the company to minimize risk and respond rapidly to trends. But speed creates pressure. Factories must turn orders around quickly, accept thin margins, compete aggressively on price. When media investigations in 2020 alleged that workers in some Leicester factories were paid as little as £3.50 per hour, far below the UK minimum wage, the brand's ethical positioning was shattered. Now, you might argue that supply chain issues exist across fashion. That's true. But Boohoo's brand was built on youth appeal, social media activism, influencer credibility. The disconnect was explosive. If you like this video, please subscribe. We want to hit 5,000 subscribers this week. Now, let's move on with the video. The July 2020 report triggered immediate fallout. Major retailers and online platforms distanced themselves. Institutional investors began selling shares. The company's stock price plummeted. Within days, Boohoo's market capitalization fell by more than £1 billion. Over the following months, as investigations continued and reputational damage deepened, the total value destruction ran into multiple billions of pounds compared to peak levels. This wasn't just a PR crisis, it was a credibility collapse. Investors began questioning governance standards, supply chain oversight, risk management, ESG exposure. In modern markets, ethical risk translates into financial risk. And Boohoo's valuation was built on growth optimism. When trust evaporates, so does premium pricing. Before the scandal, Boohoo was trading at aggressive growth multiples. After the scandal, the narrative flipped. Instead of digital disruptor, the story became under-regulated fast fashion operator. Over time, Boohoo's share price declined dramatically from its highs. Market value fell from above £5 billion at its peak to a fraction of that in subsequent years. Not all of that decline was due solely to the scandal. Broader factors played a role. Post-pandemic slowdown, inflation pressure, rising return rates, increased competition, investor shift away from high-growth stocks. But the scandal was the turning point. It shattered the aura of inevitability. Confidence, once lost, is expensive to rebuild. And in public markets, confidence drives valuation more than revenue alone. Boohoo responded with independent investigations, supply chain audits, governance restructuring, ESG reforms. It pledged to improve transparency and oversight. But here's the deeper issue. Ultra-fast fashion and ethical compliance often pull in opposite directions. Speed requires flexibility. Oversight requires control. Cost leadership requires pressure. Ethical assurance requires margin. Balancing those forces is expensive. And expense squeezes profitability. Boohoo didn't collapse into insolvency, but it lost its growth halo. Revenue growth slowed. Margins tightened. The share price remained far below peak levels. So why did Boohoo's scandal wipe out billions? Because valuation is belief. And Boohoo's valuation depended on 5 fragile assumptions. 1. That speed could scale without risk. 2. That low prices would not invite scrutiny. 3. That ESG concerns were secondary to growth. 4. That digital brands were immune to supply chain exposure. 5. That reputation could be managed quickly. When those assumptions collapsed, the market repriced the company. Not as a flawless disruptor, but as a volatile operator in a morally sensitive sector. The scandal didn't bankrupt Boohoo. It did something arguably worse. It removed its growth premium. And in public markets, that premium is everything. Today, Boohoo still trades, it still sells, it still operates globally. But it no longer commands the unquestioned optimism of 2020. It operates under scrutiny, under tighter margins, under heavier expectations. The lesson is brutal. In fast fashion, speed builds empires, but speed also magnifies mistakes. Boohoo's scandal didn't destroy the company. It destroyed the illusion that growth could outrun accountability. And in modern retail, once that illusion is gone, it rarely returns. And perhaps the most important shift was this. Boohoo stopped being judged purely on growth. It began to be judged on responsibility. In a market that once rewarded speed above all else, scrutiny became permanent. The question was no longer how fast it could scale, but how safely it could survive. Fade to black. If you liked this video, please like and subscribe. We want to hit 5,000 subscribers this week. Thanks for watching, and I see you tomorrow.